Hello, everyone, and welcome to Finance Concepts by your Finance-ista Cynthia P. Bush. Today, we are going to discuss angel investing. And so first, let's talk about what is an angel investor. Angel investors are simply wealthy individuals, exceptionally wealthy individuals, who like to invest in new, unproven companies. In return for their financial investment, they generally require an ownership stake in the private stock of the startup companies. But also in return for their financing, they are willing to open up their contact lists and provide helpful connections and other information so that the startup company can in effect grow up to become a slightly more mature company. Keep in mind, all of this is done in the private market. So you will not see this in the public stock market. These are not opportunities that the average person, including you and I, would be able to invest in. For more information on the private market, please see my video on private markets. So can you think of some famous angel investors? Here's one. This is a picture of David Lee. Way back in July of 2012, he was listed as one of the top 50 angel investors in Silicon Valley, which is where he's based. According to this blurb, he primarily focuses on industries such as retail and IT. Therefore, if you were the entrepreneur and founder of an engineering firm and you were looking for additional capital to grow your business, you may not approach David Lee because that's not an industry that he's historically shown a lot of interest in. Also notice that David tends to invest in each opportunity somewhere between $25,000 to $250,000. And way back when, over 5 years ago, he was one of the early investors in DoorDash before it became as well known as it is today. Here are another group of relatively well-known angel investors. You see them on a show called Shark Tank. And what that show is attempting to do is effectively play matchmaker. So it is matching the angel investors with entrepreneurs who have ideas and companies but need additional financing. There are significant risks to the angel investors and this type of investing. Number one, what they're investing in is new and untried and untested. And sometimes, even after many, many, many tries, whatever the product or service is just doesn't perform as well as expected. Also, the goal is normally to grow the customer base of the company, either by appealing to a need that's already there or helping customers see a need they previously didn't even know they had. But sometimes the customer base does not grow to expectations. It's just too small to be able to make money on it. Perhaps the product or service can't be priced attractively enough. Perhaps there's not enough of a demonstrated need or want, or perhaps the business isn't able to help customers envision why they should need or want this product or service. Sometimes you have a significant issue in that there is a big competitive response that overwhelms this new and relatively fragile company. And keep in mind that one of the attractive elements of angel investing is that you are investing in opportunities that have been created and developed by very creative and energetic founders. So if something happens to the founder, particularly if it's in the early stage of the company, sometimes the company just flounders altogether. Founders can become sick or ill. They can turn their interest to something else, all sorts of things. So there are significant risks to angel investors. There's also risk to the entrepreneurs and founders of these companies. Number one, losing control of your own company. That has happened and could continue to happen if you get so many investors who demand ownership stakes such that you become just a small minority owner in your own company. that can also lead to losing creative control, which is a big concern of many entrepreneurs and founders of startup companies. And then there's the financial aspect. It is possible, if the company doesn't work and has to file for bankruptcy, that you could lose significant amount of your assets or personal wealth, if you have any personal wealth. So these are very risky investments, both for the investor, which would be the angel investor, as well as for the recipient of the funds, which would be the entrepreneur and founder of these new companies. Since they're so risky, the angel investors expect significant returns from these opportunities, much more so than what they could get from a typical stock market investment, for example. But keep in mind, these investments are so risky that many of them won't work, and whoever invested money in them is going to lose all the money. These investments are typically just not going to deliver what is initially promised, but every now and again, one does work. So the angel investor is trying to avoid hitting a lot of strikeouts, which is almost impossible, but instead seeking that one big home run, because one big successful investment can compensate the angel investor for losing money on the many failures. So that's all for angel investing. Until next time, signing off,